Annuities are popular financial products that both accumulate and distribute a sum of money over an extended period of time. Sold by life insurance companies, annuities have long been used to provide a guaranteed stream of income the annuitant can't outlive. They are also a tax-advantaged way to accumulate money. There are two basic types of annuities. Immediate annuity. This is purchased with a large single premium to begin the stream of income immediately. Deferred annuity. This is used to accumulate a sum of money over time, possibly for later annuitization. It can be funded with either a large single premium or periodic premium payments. Characteristics of an annuity. Annuity accumulation period. Money deposited into a deferred annuity during the accumulation period grows through tax-deferred interest or investment earnings. This means that interest earnings and growth are not taxable until they are paid out. Tax-deferred growth is one of the main tax advantages of annuity ownership. Annuity payout period. At a given point, deferred annuities can be annuitized, which begins the annuity's payout period. The accumulated funds are converted into an immediate annuity that distributes ongoing, periodic income payments to the annuitant. How long those payments last depends on the annuity payment settlement option chosen by the annuity owner. Prior to annuitization, the contract owner is permitted to withdraw money from the annuity, but once an annuity has been annuitized, those funds are no longer available for withdrawal, other than in the form of scheduled income payments to the annuitant. Key point. An annuity can serve two purposes. It can accumulate money on a tax-deferred basis. It can distribute a guaranteed amount of money for a guaranteed period, even one's life or longer. Because they accumulate money on a tax-deferred basis and can distribute that money over the annuitant's lifetime or even longer, annuities are popular retirement planning products. Annuity riders. To add value to their annuity, owners have several riders they can choose from. A guaranteed income rider lets the annuitant receive a payment for life without having to annuitize the full contract. The payment stream is funded with a single lump sum premium, drawn from the deferred annuity to which the rider is attached, from which payments are made. This type of rider can help provide retirement income without irreversibly committing all the funds in the deferred annuity. An annual fee is usually charged to the deferred annuity for this feature. A death benefit rider guarantees that if an annuitant dies before annuity payments begin, or soon after the distributions begin, a beneficiary will receive at least the balance of the money invested in the annuity. A return of premium rider ensures that the annuitant will receive no less than the amount invested in the annuity. It is used mostly with variable annuities, which invest their funds in securities-based subaccounts that are not guaranteed. Liquidity provisions. Some provisions and riders allow distributions from a deferred annuity without a surrender charge. Common examples include charge-free withdrawals provision. Contract owners can withdraw a specified percentage, for example, 10%, of the accumulated value annually without a surrender charge. Terminal illness rider. This rider waives surrender charges if the annuitant incurs a terminal illness. In most cases, death must be expected within 1 year of diagnosis. Disability rider. With this rider, the contract owner can withdraw funds without a surrender charge if the owner becomes disabled and remains so for a specified period of time, usually ranging from 60 days to 1 year. Long-term care rider. This rider lets the contract owner withdraw funds without a surrender charge if confined to a nursing home. Group annuities. Annuities can also be used by employers on a group basis. A group annuity has the same features as an individual annuity except that it is written on a group contract basis. There are several types of group annuity contracts. In general, an employer is issued a master contract that provides annuities to covered employees when they retire. Individual group members hold certificates of participation. When a group member retires, an individual annuity contract is issued using funds accrued on the participant's behalf in the group plan. The contract states the monthly payment amount to be made to the retiring participant. Insurance aspects of annuities. Annuities and life insurance share common attributes, yet in some respects they are the exact opposite. Annuities are often promoted as insurance against living too long. Both life insurance and annuities are based on the actuarial principles of mortality, interest and expenses. In fact, it is because of their experience in these areas that life insurance companies can guarantee a stream of income for an individual's lifetime. Insurers can guarantee lifetime income because annuity purchase rates include a mortality charge that protects the insurer when annuitants live beyond their life expectancy. But the primary purpose of life insurance is to guarantee the creation of a sum of money at a precise time in the future, i.e., the insured's death, while the primary purpose of an annuity is to liquidate a sum of money through the distribution of guaranteed income payments over the annuitant's lifetime. In reality, the lines blur. Deferred annuities can be used to accumulate a sum of money, just as life insurance death benefit settlement options can distribute a sum of money over time, even the beneficiary's lifetime. For your review, deferred annuities are used to accumulate money on a tax-deferred basis. Immediate annuities are used to distribute a sum of money over a guaranteed period, even the annuitant's lifetime. Annuitization refers to the conversion of a deferred annuity into an immediate annuity. Prior to annuitization, the owner can withdraw money from a deferred annuity. After annuitization, annuitized funds are no longer available for withdrawal except through the scheduled annuity payments. Riders that add value to the annuity, guaranteed income rider, death benefit rider, and return of premium rider, used with variable annuities. Provisions and riders that allow greater liquidity, charge-free withdrawals provision, terminal illness rider, disability rider, and long-term care rider. A group annuity has the same features as an individual annuity except that it is written on a group contract basis. Please pause the audio and watch the video. You can restart the audio playback at any time.
This lesson introduces the important topic of annuities. As a licensed life insurance producer, you'll be authorized to sell annuities. Your life insurance license exam is going to ask you a number of questions about annuities, so it's important that you understand how this very important product works. Annuities are nothing like life insurance, and yet they are true mirror images of each other. Now, what do I mean by that? Well, life insurance and annuities share the same actuarial factors of mortality factor, interest credit, and an expense load. However, they do function with opposite purposes. Whereas life insurance exists to, we use the term, create an estate, that is, through the payment of money to the insurer, build up to the payment of a significant death benefit upon the death of the insured. An annuity does just the opposite. We say that it liquidates an estate, or in other words, it takes a large sum of money that the insurance company has, which has been provided by the annuitant, and distributes that through a series of payments. It liquidates that money through a series of payments to the annuitant. So they're fundamentally based on the same factors, but they work at very different purposes. An important point that I want to make here is that annuities and life insurance share some of the same tax advantages and treatment during the accumulation stage, but they have very different treatments when it comes to money being paid out. Both life insurance and annuities share the same benefit of tax-deferred growth. In the case of life insurance, the cash value grows on a tax-deferred basis, and with an annuity, same thing. As long as the money is building inside that annuity, it grows on a tax-deferred basis. However, when the money is paid out, the rules change significantly. As we know, with life insurance, there's a very important benefit in the tax-free death benefit. With an annuity, there is no way to receive tax-free distributions. However that money is paid out with an annuity, there is going to be a taxable event on the amount of the earnings that are distributed. We'll talk more about this in a different lesson, but I wanted to make that distinction right now to help you understand that as similar as they are, there are some important differences in the tax treatment of annuities and life insurance.
Okay, everybody, so as you know, if you've been following along, we have our quizzes at the end of every lesson. So no exceptions here. Which is correct regarding annuities? All of these are correct except one of them. Annuities provide income payments that annuitants cannot outlive. The insurer guarantees income payments for whatever annuity payment period the annuitant selects. Deferred annuities are suitable replacements for life insurance. The insurer can provide a guaranteed stream of income for a single life or joint life based on life expectancies. So be sure to comment, like, subscribe, and comment if you would like to do any of these lessons live so we can all take these questions together. And then I can set up a live class or whatever you want to call it. Okay, so I know everybody is watching and staying till the end. That would be nice if somebody would comment. I have no clue what this is. I'm just going to guess. This is why I wanted to do it live, so y'all could help me out here. What is the name of the period during which premium funds are paid into the annuity contract? I think it is annuity period. Which of the following statements best describes the purpose of annuity payout period? To distribute the forms and guarantee periodic payments over a time period selected by the insurance company. I have no idea whether these are right or wrong. A deferred annuity rider that lets the annuity owner commit only part of the annuity's funds to providing guaranteed lifetime income. Be sure and go back over these if you're having trouble in this area, because I probably will myself. If you're planning on taking the test, or you already took it and you failed this part of the test. A deferred annuity rider lets the annuity owner, commit only part of the annuity's funds to provide guaranteed lifetime income. Leaving the remainder available for withdrawal at the owner's discretion is called a guaranteed income rider. I'm not sure if that's correct or not. I only got one right. So the first one, the only one, everything is correct except this one. Deferred annuities are a suitable replacement for life insurance. This is actually wrong. Everything else is correct. Deferred annuities are not a suitable replacement for life insurance. That's how you want to read this so you'll remember it, okay? It is not a suitable replacement for life insurance. Number 2, the accumulation period is the name of the period which premium funds are paid into the annuity contract. Annuity period is made up term. That is not correct. Question 3, which describes the purpose of the annuity payout period. To distribute funds in the form of guaranteed periodic payments over a time period selected by the annuity owner. The annuity owner, not insurer, selects the annuity payout period, which can set a number of years for the length of the lifetime. And finally, number 4, which I actually got correct, is the guaranteed income rider. It's a deferred annuity rider that lets the annuity owner commit only part of the annuity funds. The guaranteed income rider lets the annuitant receive a payment for life without having to annuitize the contract. All right, that's it on this lesson. I thank everybody for subscribing, for liking, for staying till the end. So the next lesson will be immediate versus deferred annuities. And so if you need help in that area, be sure and come back.